Hey everyone, thanks for joining me for this video. In this video, we're going to be talking about 5 stocks that are buying back their shares in huge quantities. We're going to start off by talking about the benefits of share buybacks before going into a bit of depth on each of these 5 companies. So if you like this kind of content, be sure to hit the thumbs up button and consider subscribing to my channel if you haven't already. Okay, so getting into this video. Share buybacks are one of 2 ways that companies tend to give capital directly back to shareholders. The first one is through dividends, and the second one is through buying back their own share. So then the share of the company that each individual shareholder owns is worth more of the company. So they're just buying back more shares essentially and percentage of the company on your behalf. Now, lots of people like dividends. Personally, I really like dividends as well, which you know if you've watched lots of my videos. But technically, share buybacks, as long as they're done when the stock price is at a reasonable price or a discounted price, can actually be the better way to create value a long time for shareholders. It's a much more tax efficient way of allocating capital back to shareholders, since we don't have to pay taxes on that gain that we're getting in the total value of each share because it's unrealized until we exit the position. And also, if you can get a company that's really good at buying back their shares when they're at the low end of their 52-week ranges and they have the patience in order to do that, then they can also create a lot of value by canceling shares at lower valuations as well, which returns capital to you because you can dilute, or not dilute, but you can cancel out more shares at attractive prices. And at the end of the day, when the company's buying back these shares, it's really you buying back or buying into the company more because it's using capital in the company that you're entitled to as a shareholder. So that's a bit of background just on share buybacks in general. Now going into 5 companies that do a lot of share buybacks. As you can see on the screen through that little blurb, the first company in Canada is Canadian National Railway. Now, all the railways buy back a lot of shares because they have limited investment opportunities in their core businesses. So they tend to allocate a lot of their capital into share buybacks and also increasingly into dividends. And that is a byproduct of, once again, not having a ton of opportunities to invest in their own businesses because they're really developed companies. Also having really strong moats. Not really needing to invest heavily in CapEx in order to defend those moats or build out those moats more than they already are. So this company in particular has a market cap of about 100 billion Canadian dollars, trading about a 20 times multiple, 2% dividend yield. Looking at the company a bit more, you can see in 2021, so I guess this is actually a bit of a dated, I got last year's investor report here. They did about $3.3 billion in free cash flow. So that's free cash flow that they got from their operations that they have to allocate to reinvesting in the business, paying out dividends, as well as potential share buybacks here. And as we look at the total value of the company at about 100 billion, 2% dividend yield, so they're paying out about $2 billion in dividends. So that leaves them with an extra billion and a half dollars to allocate to things like share buybacks after they invest in the business. Looking at their share buybacks over time, this company has been buying back shares for decades, and this just has the last 14 years here. But you can see 14 years ago, the company had about 950 million shares outstanding, and today they have about 660 million. So said another way, if you had 100 shares in the company back in the day, you would own 1/95 millionth. Or am I doing the math on that wrong? Maybe 9.5 millionth rather. And now you'd own 6.6 millionth. Not by investing any more money, just by holding your shares, your 100 shares, and letting the company buy back shares for you within the company. So that's pretty impressive, even though it's a pretty long time horizon to cancel out about a third of the shares of the entire company for a developed company like this. And just the consistency, you can see year over year, buying back shares, canceling out shares for shareholders. They paused or went down a lot during the early bit of the pandemic there that you can see, but then they just doubled down went really heavy into it afterwards as they were in a really good capital position. So you can tell it's been a huge priority over the last 10, 15 years to pass on capital to shareholders through share buybacks. And I think it's going to continue on with this company. And that's one of the reasons I really like CN Rail, is because on top of the dividend that they increase every year, you're also getting a higher and higher percentage of the company every single quarter that you own the company. So that is the first stock, CN Rail, that's known for buying back tons of their own shares. The second stock is Visa. So Visa is a company that's gone on a huge run here in the last year, up 25%. Even longer term, you can see the company's just done tremendously well. One of the things about Visa's business is they just have tons of free cash flow. You can see here, just year to date in the first 3 quarters, $13 billion of free cash flow. They only paid $2.8 billion out in dividends, but bought back over $8 billion of shares with it. And as we just go closer to their overall business, if I can get it here, you can see just how profitable this company is. $8.1 billion on the top line on revenue. And on that $8.1 billion, they had net income after tax of 4.2 billion, sorry. So over 50% net margins on revenue to net income on the quarter. That's just tons of capital. They have a huge moat on their business, which enables them to essentially allocate all of their money out. And that's what you're seeing here. Out of the $13 billion, they have about $11 billion so far this year in buybacks and dividends that were paid out. So looking at Visa's chart, they have continued to buy back shares. Very similar picture to CN Rail that you saw on that last chart there. So even if I look at since 2013, so give it a 10-year time horizon, they went from 3.7 billion shares all the way down to about 2.3 billion. So they've bought back about 40% of the company in a 10-year span. That's super impressive for a company at this level. And just like I was saying off the bat on how lots of these companies can create a lot of incremental value by buying back shares that you just can't get through dividends, look at the valuations that the company was buying back their share at in droves in 2013, 2014, 2015. It's about 20% per share that the stock's trading at today. So shareholders who held through that time period, they pretty much got a 500% return on that capital that Visa was allocating to share buybacks instead of dividend payments. And it's really hard to tell. Obviously, hindsight's 2020, but it could be very true that this $8 billion that they're buying back their shares today on behalf of shareholders, 10 years from now, we may look back and say the same thing. Wow, I really am grateful that they bought back all these shares on my behalf, increased my ownership stake in Visa, as opposed to paying me a bit of a higher dividend, which who knows what I would have done with it. But maybe they know better than we do. They have a better vision of the business. They better understand the mode, the competitors, things like that. So I think this is a great example of where share buybacks have worked out tremendously in compounding shareholder value over the long term. Stock number 3 here is another US company. It is Apple. Even though this is a US company, lots of you guys may be Canadian. Tons of us have exposure to Apple in one way or another, whether you own the S&P 500, in your retirement accounts, in any type of ETF, Apple is likely there, the biggest company on the North American stock market here. And let's just take a look at their business here. You can just get a sense for how profitable this company is. $82 billion of sales in the 3-month period ending July, almost $300 billion year to date. And then in terms of gross income, over $128 billion, operating expenses, $41 billion. So they have operating income of almost $90 billion in 9 months. So almost $10 billion a month in operating income. And they're such a developed business. Obviously, they invest in R&D and all these other things, but they just do not know what to do with all the capital they're spinning out. And you can really see that come to fruition in their share buybacks. Now, they've done a lot of splits, but current day share count on Apple 10 years ago, if I go back to 2013 here, it's 26 billion shares. And in the last 10 years, you can see it just go down, 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 down every single quarter, from 26 billion down to 15 to 16 billion. So similar to Visa, they've bought back about 40% of the company. And I have the exact same thoughts on this one. As I look at the company over that time period, that's turned out to be a phenomenal investment for the shareholders who've been able to hold this company long term, because their capital was going, instead of a dividend or a big dividend, was going to buying more Apple share on their behalf for about 20 cents on the dollar versus the price that it is today. So Apple shareholders should be really happy with that decision. Going on to the fourth stock here, it is Alimentation, Couche. This is a Canadian company operating out of Montreal, but they're really a global company, global leaders in convenience stores. They also have some gas stations and whatnot. Looking at this company, they've done really well, double up over the last 5 years, but just longer term, they've also done really well here too. And looking at their free cash flows, you can see similar themes across these companies. All of them have really good free cash flow conversion, have relatively strong moats, have very developed businesses where they don't have a ton of opportunities for expansion into different sectors or whatnot, or variable expansion of their business. And that's why they allocate a lot of their free cash flow back to shareholders via share buybacks. You can see here for Alimentation, Couche, almost $2.5 billion the last 4 years, every single year in free cash flow, which is represented by the orange line. So 2.2 there, 2.4, 2.2, 2.4 billions of dollars every year in free cash flow that they're trying to figure out the best place to allocate it. As we look here, it's a $70 billion company. So $2.5 billion of free cash flow a year. They pay a very small dividend. Looking at their shares outstanding, you can see very similar picture here. Just from 2019, they went from 1.13 billion shares to under a billion. So about 15% of the company bought back in the last 4-ish years, 4 to 5 years. So that's pretty good. You're getting 2-3% of the company bought back a year. So if you owned, 1/millionth of the company, 3 years from now, if they keep on this pace, you'll own 1/900,000th. 3 years after that, you can own closer to 1/800,000th. And it just really compounds your ownership. And especially when you have a company and a management team that's executing really well and has been able to increase the net value of the equity, owning more and more of that equity over time on the other side of the equation really compounds your return on investment over the long term. As you can see on all of these companies that are really big share buyback companies have really delivered in creating equity value for shareholders too, to compound the returns. And if you've just held on to these companies that are doing huge share buybacks that I'm showing on this list over the last 10 years, you'd be crushing the stock market. Okay, going into my fifth and final stock, it is Alphabet or Google. So Google here over the last 5 years, similar, up 130%. Long term, a bit of bulkiness throughout COVID like some of the other tech companies, but generally has just done tremendously well. This company has tons of cash. If you look at just their balance sheet here, they have $165 billion of current assets, over $100 billion in just cash equivalents like T-bills, stuff like that. So they have tons of money just on their balance sheet. In addition to that, they're just printing money still on their search engine primarily, made over $16 billion of net income last quarter. So on top of their $100 billion that they're just sitting on in cash, they're also making over $5 billion a month. And now they're investing a bit more in cloud over the last few years. They have some competition on AI with Microsoft that they may be investing a bit more into. But generally speaking, this is still a cash cow of a company. And they have a lot of capital. They have no dividend. So they've really started to buy back shares more heavily the last few years. And I can see like Apple that we looked at earlier, who kind of went from, maybe diluting shareholders a tiny bit with stock options and stuff to heavily buying back shares. I can kind of see Google at the very beginning of that journey here, kind of dipping their toe in, buying back like 1% a year, and now they're going closer to 2%, now 3%. So I can see Google kind of at the beginning of that journey of returning excess capital to shareholders through share buybacks. They don't want to declare a dividend yet, maybe too much commitment, or they want to stand by, increasing the price of the stock before returning money out of the company's hands. But it really goes to show that it seems like they're pretty committed on this journey, going from about 15 billion shares at current share count down to 13.5. So about a 10% reduction in shares in the last 5 years or so. So not too shabby for a company who's kind of more new on the buyback game versus some of these other companies that we looked at, like CN Rail here, who's just been doing it forever. So these are 5 companies that are kind of known for exercising buybacks over the last few years. I'm sure there's a lot more of them. If you have your favorite company that's buying back a lot of shares, let me know in the comments. Personally, I think share buybacks are a great way and a great thing to look for long-term shareholders. And these companies have really proven that out over the long term of being able to provide really strong overall returns. And some of that has been complemented by the buybacks at the lower prices. So let me know what you think of these companies. If you have other companies as well, I'd love to hear from you in the comments. If you waited till the end of this video and watched all the way through, really appreciate you and the time that you spent here. Be sure to give me a big thumbs up on the video. I really do appreciate it, and I will see you guys in the next one. Thanks.